Hello and welcome. In this lecture video, I'll be talking about the methods for estimating bad debts. And this lecture video starts on page 187 of your course pack, okay? So there are two different ways for estimating bad debts. There's the percent of sales method. So basically we say 1%, 2%, whatever percentage of our credit sales we don't think we're going to collect, okay? The other way is the percent of receivables method. So what we say is that we want the allowance for doubtful accounts to be 5%, 2%, 1%, or whatever percentage of our accounts receivable. So these are the two different ways for estimating bad debts expense. Okay, so remember what we have to do at the end of the accounting period. We have to do that adjusting journal entry to recognize bad debts expense. That adjusting journal entry, remember, is debit bad debts expense, credit the allowance for doubtful accounts. And so what we're talking about in this video is how do we figure out how much to debit bad debts expense for? And those are the two methods. So let's talk about the percent of sales method, the first method, in a little bit more detail. And basically all we do is we take our current period sales times our bad debt percentage. So this is the estimate. We say, well, in the past we've not collected 1% of our sales, and we should really base this off our credit sales. Because if we sell something for cash, right, if we have a cash sale, well, we collected cash right away. So you don't base it off cash sales, you base it off credit sales. That makes more sense. And we basically would look at history and say, well, in the past, we've not collected 1%, whatever percentage of our credit sales, and we multiply that percentage times our credit sales, and that's how much we debit bad debts expense for. All right? So let's look at this example. Musicland has credit sales of $400,000. All right? And what we also have is that $400,000 for the year. Management estimates that 0.6% of our credit sales would be uncollectible. What is the journal entry? So we would debit, remember this would be on 12/31. So we would debit bad debts expense for $2,400, and then we would credit the allowance, and I'm just going to write allowance, but remember the full word, the full account name is allowance for doubtful accounts. So I will just say credit the allowance for doubtful accounts, and I'm just writing allowance, just being lazy, just writing allowance. Allowance for doubtful accounts is the full name for $2,400. So debit to bad debts expense, credit to the allowance for doubtful accounts for $2,400, okay? The other way that we can do it is percent of receivables method. This way is a little bit trickier, okay? So the percent of receivables, what we want to do is we want the allowance for doubtful accounts to be a certain percentage of our accounts receivable. But here's the tricky part, is that the allowance for doubtful accounts is a permanent account. What does that mean? Remember, think back to Chapter 4, closing journal entries. Which accounts do we close out? The temporary accounts. We don't close out permanent accounts, balance sheet accounts. So the allowance for doubtful accounts probably already has some dollars in it. It probably already either has a debit balance already. Before we're doing this end of period journal entry, it either has a debit balance or it has a credit balance. It has some dollars in it. So we have to consider that when we figure out our journal entry, when we do our journal entry, okay? So let's talk about that with our example right over here. Musicland has $50,000 in accounts receivable and a $200 credit balance in allowance for doubtful accounts. So this is what I mean. We have this $200 sitting in the allowance for doubtful accounts. Why do we have that? Because allowance for doubtful accounts is a permanent account. It has dollars in there. It already has dollars in there. So we have to consider that, because what we're saying here is that past experience suggests that 5% of receivables are uncollectible. What that means is that we want the allowance for doubtful accounts, we want the allowance to be 5% of $50,000. So we want it to have a $2,500 credit balance. We want the allowance for doubtful accounts to be $2,500 credit balance after we do the journal entry. But I'm going to do my T account. Remember, T accounts are fun. They help you. So I've got my T account down here for the allowance for doubtful accounts. Here's the tricky thing, is I have $200 sitting in there already before I do this journal entry. So I've got $200 sitting in there. I want it to be $2,500. I want it to be $2,500 after I do the journal entry. So how much do I need to increase it by? $2,300. Okay, so my journal entry would be debit bad debts expense, credit the allowance for doubtful accounts for $2,300, not $2,500, because if you make it $2,500, what's the ending balance? $2,700. But what we want is that after we do this journal entry, we want the allowance for doubtful accounts to be 5% of the $50,000 or $2,500. That's what we want the allowance to be. Okay, so let's say that instead of $200 credit, this is $200 debit. So we got 200 over here. And what we want is it to be 2,500. How much do we have to increase it by? 2,700. So then we would debit bad debts expense 2,700, credit the allowance for 2,700. That's what we would do. Okay? So when we look at the journal entry then, considering this problem, what would be our journal entry? Again, this would be done on 12/31. We would come over here and we would debit bad debts expense for $2,300, and then we would credit the allowance for doubtful, and I'm running out of room, so I'm just going to say allowance for doubtful, but remember the whole name is allowance for doubtful accounts, for $2,300. So debit bad debts expense, credit the allowance for doubtful accounts for $2,300. How do we get $2,300? Well, look at the T account. We started with 200 right there, and then we had our 2,300 added to the 200 to get to that 2,500. Okay? All right. So now let's talk about a variant of the percent of receivables method. Okay? Because what we're saying right over here is that overall, 5% of our receivables are uncollectible. But there's no attempt to go through and say, well, the ones that are past due by 30 days are 2% uncollectible, and those ones that are 6 months that we haven't collected on, well, maybe that's more like 10 to 20% that we're not going to collect it. So as time goes on and you haven't collected the money, it's less likely that you're going to collect the money, right? Just like if you lent money to a friend, and as time goes on, it's probably less likely that you're going to get paid. Same thing here. So what we do as a variant to our percent of receivables method, we look at our aging of our receivables. And if we look at this figure down here, we have our aging by category. And what we have is our customer, Carly Abbott, total 450, it's not due yet. And then of those that are not due yet, it's 2% uncollectible. Okay? And then we have our next customer, Jamie Allen, 710, and they're 31 to 60 days past due. And then look at it's 10% that we're not going to, 10% likelihood that we're not going to collect it. Then we have our next customer, Chavez, and we have a total of 500, and that's split between 300 not due yet and 200 1 to 30 days due. The 300 times the 2%, right? That's added in to get that 740 number, and then we take the 5% of the 200 to come down here and get to our 325, okay? Plus our 190 gets us our 325 down there of our estimated uncollectible. And then we look at our final customer right over here, Valencia Company. 61 to 90 days past due is $100, but it's 25% that we're not going to collect it. And they also have one that's over 90 days due, $640, and it's 40% likelihood that we're not going to collect it. So then what we do is we add up all those that are not due yet, and we have total receivables of $37,000 times 0.2%, $740 would be the estimated uncollectible and not due yet. And then we look at our total receivables for 1 to 30 days, $6,500, 5% uncollectible, $325 estimated uncollectible. 31 to 60 days, $3,700, 10% uncollectible, $370. 61 to 90 days, $1,900 total receivables, 25% uncollectible, $475. And then $900 here, total receivables for over 90 days, 40% likelihood that we won't get it, $360 estimated collectible. We add up all of our estimated uncollectibles, and we want, what this is saying is we want our allowance for doubtful accounts to have a balance of $2,270. When we add up all those estimated uncollectibles, we get the $2,270. And what this is telling you is that you want the allowance for doubtful accounts to have a balance of $2,270. But if we look at this over here, let's assume that the allowance for doubtful accounts before we do our journal entry has that credit balance of $200. So we look at our T account. It's got this $200 credit balance. We want it to have an ending balance of $2,270. How much do I need to increase it by? $2,270 minus the $200, $2,070. So that would be my journal entry. Debit, bad debts, expense, $2,070. Credit, my allowance for doubtful accounts. Again, I'm just writing allowance because I'm running out of room. $2,070 right there. Okay. So I say right over here, okay, what would a debit balance, so if this were a $200 debit right over here, what would that mean? It means that the amount of write-offs that you had during the accounting period exceeded the allowance for doubtful accounts. Because remember, when we write off the allowance for doubtful accounts, right? When we find out that somebody can't pay us, we debit the allowance and then we credit the receivable. So if we have a debit balance in the allowance for doubtful accounts before we do our adjusting journal entry here on 12/31, that means during the year we wrote off more receivables than we estimated at the end of the previous year. That's what that means. Okay? So at the end of the previous year, we underestimated how much we thought we were going to write off. If you have this credit balance, right, you overestimated at the end of the previous year. Okay? That's what that means. All right, so I'm going to end this lecture video now. The next one will be doing quick check problems. Thanks so much.